Hello students, and a very warm welcome to this new set of lesson videos from the chapter Financial Statements of a Company. You all must have gone through our lesson video series on financial statements in your 11th standard. Today's lesson series on financial statements of a company is a sequel to the same. We have till now learnt quite a lot on the process as to how a company operates in terms of raising capital and its utilization. Now, we need a detailed understanding as to how the financial statements of a company operate. Financial statements are the end result of the entire process of accounting. These statements need to be arranged with suitable content and in proper format so that meaningful information can be generated for the users of the financial statements. Remember Jim and Minnie from Tony's Furniture Shop? Today, we are going to have this session along with them. So, to define, financial statements are the basic and formal reports through which the corporate management communicates the necessary financial information to the different end users, including the owners and various external parties. Minnie has become quite a pro now. She starts writing and explaining the primary nature of financial statements through a few points. Recorded facts. Financial statements follow recorded facts from the books of accounts, which are all in historical value or original cost. Accounting conventions. Certain accounting conventions say valuing of inventory at cost or market price, whichever is lower, are followed, which make the statements comparable, simple, and realistic. Postulates. Certain basic assumptions or prerequisites known as postulates are the basis to the preparation of financial statements. Examples of such postulates are going concern postulate, money measurement postulate, realization postulate. Personal judgment. Now, the facts and figures presented through financial statements are to some extent based on personal opinion, estimates, and judgment. And now, it's Jim's turn. He now has to explain the specific objectives of financial statements. To provide information about the profit earning capacity of the business. To provide information about the relevant cash flows. To judge the effectiveness of management. To provide useful information about all the economic resources and obligations of the business. Information about the various business activities affecting the society. Disclosing the relevant accounting policies. And now, both the budding accountants list out the types of financial statements. The balance sheet, the statement of profit and loss, the cash flow statement. Now, every company which is registered under the Companies Act 2013 is required to prepare its balance sheet, statement of profit and loss, and notes to accounts in accordance with the manner prescribed in the revised Schedule 3 to the Companies Act 2013. This sinks in the disclosure requirement and to converge with new reforms. Now, Minnie draws up a standard balance sheet and both of them analyze and discuss. Minnie also calls out the important features of presentation which are to be remembered and applied correctly. This is applicable to all Indian companies preparing the financial statements as per Schedule 3 to the Companies Act 2013. It is not applicable to insurance or banking company for which a form of balance sheet or income statement is specified under any separate act. Disclosure on the face of the financial statements or the notes is essential and also mandatory. Accounting standards prevail over the Schedule 3 of the Companies Act 2013. The terms in the revised Schedule 3 will carry the meaning as defined by the applicable accounting standard. There should be a perfect balance and precision between disclosure of excessive detail that may not help the users of financial statements and not providing important information. Classification of current and non-current assets and liabilities. Rounding off the figures in the financial statements is mandatory. Vertical presentation format is the prescribed one for the presentation purpose. The debit balance in the statement of profit and loss is to be reflected in the liability side only as a negative balance under the head reserves and surplus. Any share application money pending allotment should be mandatorily disclosed. The sundry creditors and sundry debtors are to be termed as trade payables and trade receivables. Both Minnie and Jim carefully read between the lines. It's indeed very important, and unknowingly, we often tend to miss so many of them. Let's close our lesson for today here. In our forthcoming lesson videos, we will delve deep into the different items of balance sheet and many more aspects of the financial statements. Till then, happy learning.